Welcome to Alpha Recap from stockalpha.ai. I'm Gareth, and today we've got a market tape that's part deal-driven momentum, part regulatory speed bump. Think big corporate checks and government projects pushing materials and industrials forward, while state rules and liquidity questions keep everything else on edge.
I'm Lucy. Good to be here. That's a nice summary, Gareth. And nowhere is that patchwork more visible than in today's headlines. We had a string of big-ticket items: a $3.45 billion utilities takeover, a $450 million US-backed alumina and gallium project, a $1 billion waste services merger, Blackstone planning a $475 million bet on automation, and even a $10 million corporate Bitcoin allocation at Stake and Shake. That's a lot to unpack.
Exactly, and if you squint at the tape, you start to see a clear winner: materials and industrials. Government money and corporate consolidation are giving earnings more visibility there. But it's not all sunshine. Areas like hemp-derived products, crypto, and some pockets of energy are getting hit by rules and liquidity concerns.
Let's break that down. Start with materials. The $450 million project for alumina and gallium is explicitly about securing inputs for semiconductors and advanced manufacturing. That's industrial policy in action, and it matters because it reduces some of that geopolitical supply risk investors hate.
Right, and layer on the $1 billion waste services merger. That's consolidation, improving scale, pricing power, maybe free cash flow. For investors, that's the kind of structural change that can move margins over time.
And industrials pick up the baton from there. Think TSMC's US ramp and the tariff thaw between Canada and China on electric vehicles. When large chip makers and EV supply chains accelerate in the US and trading partners smooth things out, demand for capital equipment, specialty chemicals, and logistics spikes.
It's the classic CapEx chain reaction. Factories need chemicals, power, specialty metals, machinery, all the things materials and industrial suppliers make. So order books and backlogs become the numbers to watch.
Switching to real estate, mortgage spreads are moving back toward long-run norms and interest rates have steadied. That's supporting a brighter near-term outlook for existing home sales in 2026 and giving home builder names and some REITs a lift.
Quick explainer for listeners: mortgage spreads are basically the extra yield lenders charge over government bonds. When those spreads tighten, mortgages get cheaper relative to bonds, which helps home buyers and supports housing activity. So even if rates are higher than old norms, if spreads normalize, that's constructive.
Good primer. Now for the other side of the ledger, cannabis and hemp took a hit with Indiana tightening rules around intoxicating and synthetic hemp THC products. That's another reminder that state-level actions can change a company's available market overnight.
Exactly. The cannabis story is still very local. One state's law can be a material revenue swing for a company that sells hemp-derived products nationwide. That makes ownership in that space almost binary. Either your exposure is protected or it isn't.
Crypto is doing the same balancing act. On one hand, adoption headlines are positive: corporate treasurers buying Bitcoin, and engagement between a major crypto exchange and the White House. On the other hand, liquidity worries and rising central bank digital currency volumes are telling us structural risks remain.
It's the crypto paradox: adoption and legitimacy versus liquidity and regulatory uncertainty. $10 million of corporate Bitcoin is a headline grabber, but it doesn't solve a thin market or a surprise regulatory move.
Energy is another mixed bag. Egypt sealed about $1.8 billion in renewable deals, which is encouraging for project developers and equipment manufacturers. But then you've got places like Cuba, facing acute fuel shortages, underscoring that energy security is uneven globally.
So the market is bifurcated. Capital flows into projects where policy and finance align, and huge headaches persist where they don't. That creates winners and losers even within the same sector.
Let's talk utilities for a second. A $3.45 billion deal in that space shows investors still value regulated cash flows. Utilities trade as bond proxies sometimes, but they're not free of new risks. Data center customer concentration and permitting reforms are real issues.
Yes, if a utilities revenue depends on a handful of big data center customers, that's a concentration risk. Permit delays and local opposition to siting can also hit project timelines and earnings, so not all utilities are created equal.
One theme I want to highlight because it's playing out across consumer and retail: automation and logistics. Blackstone's planned $475 million investment in Ahold's automated distribution center is a perfect example. Private capital is ploughing money into automation to reduce labour cost and increase throughput.
And that feeds a neat cross-sector chain. Automation boosts demand for industrial robotics and warehouse tech, which helps industrial suppliers and logistics REITs. Investors can play it through hardware and software vendors or through real estate that hosts the new automated centres.
Okay, let's get practical. If you were building a portfolio today, what would you overweight and what would you avoid?
I'd overweight materials and industrials tied to semiconductor and electric vehicle supply chains. These segments benefit from government-backed projects and reshoring, which creates more predictable demand. Also, be selective in utilities. Favour those with diversified customer bases and lower permitting risk.
On the retail side, rotate toward automation and logistics plays. If you want to keep a toe in crypto, size exposure to scenarios, one where institutional flows increase and one where regulatory clampdowns bite. For cannabis and hemp, treat exposure as location dependent, map revenue by state, and consider reducing risk where new laws are likely to land.
And in real estate, prefer names that are duration hedged with stable cash flows. Look for REITs with strong balance sheets, near-term lease resets, and exposure to logistics and automation demand. For energy, separate infrastructure winners, developers and equipment makers, from regional losers exposed to sovereign or counterparty strain.
You mentioned risks. Implementation risk on industrial projects like TSMC's ramps and tariff shifts can take time or hit setbacks. Regulatory surprises, think state hemp laws or federal crypto guidance, can also reprice stocks quickly. And interest rate moves could put the brakes on the housing rebound if mortgage spreads widen again.
Liquidity shocks in crypto or niche credit markets are a final watch point. Adoption headlines can mask thin market structure underneath. That's why scenario planning matters more than ever.
Quick note on one technical term we've been using: CBDC, or central bank digital currency. It's basically a digital form of a country's money issued by the central bank. Rising CBDC volumes change how governments think about digital payments and could affect private crypto markets and liquidity.
Right, which brings us back to the big idea. Today's market is being shaped by execution and policy more than by broad sentiment. Deals and targeted government support are concentrating returns in materials, industrials, and parts of real estate, while politically sensitive and liquidity-dependent areas face headwinds.
Before we wrap, let's give listeners 3 things to watch over the coming weeks. 1. The pace of industrial project implementation. Do TSMC and EV supply chain projects hit their timelines? 2. The trajectory of interest rates and mortgage spreads. Any repricing there changes housing and REIT dynamics. 3. The regulatory calendar for cannabis, hemp, and crypto at both state and federal levels.
And some final quick takeaways. Favour businesses with visible cash flows and exposure to reshoring and automation. Be selective in politically sensitive sectors and use today's dispersion to pick high-conviction opportunities rather than making broad sector bets.
To recap the headline numbers for anyone taking notes: $3.45 billion for the utilities deal, $450 million for the alumina and gallium project, $1 billion for the waste services merger, $475 million from Blackstone into Ahold's automated distribution center, $10 million of Bitcoin at Stake and Shake, and about $1.8 billion in renewables deals in Egypt.
That's a lot of capital telling a story. Thanks for listening. We'll be watching order books, mortgage spreads, and the regulatory docket closely, and we'll bring you updates as these stories evolve.
I'm Lucy. Thanks for joining us. If you liked this recap, check out more insights at stockalpha.ai. Until next time, stay curious and keep your risk checklist handy.